Frontline indices see some green, but the market breadth is negative, indicating caution and uncertainty given big events later in the week. IT and financials eke out gains, but metals and energy drag.
Muthoot Finance reports a heady 42% growth in first quarter, upping the likelihood of a significant guidance revision next quarter. The lender says tighter unsecured lending aided growth, while lower NPAs and ARC receipts helped yields. The stock jumps in double digits.
Infosys will pick up a 75% stake in a client Telstra's arm, Verisent Group, for over $150 million. The move is seen strengthening Infosys' presence in Australia with the company's wide relationship team as well as teams of 650 engineers.
JSW Group's cement arm, JSW Cement, lists at a small premium to its offer price of 147, translating into a market cap of over 20,000 crores. The cement maker aims to double its capacity from 20 to 40 million tons before the end of the decade.
Hello and welcome to Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well as Ekta Batra. And you can see at the bottom of your screens, you do have the WPI inflation data that has just come in. Manufactured product inflation data is what you were seeing right now on the screens. The July WPI inflation is seen a deflation actually of 0.58% this time. So yes, that is what we're seeing and watching out for. Primary article inflation is also seeing a deflation actually. That is at 4.95% as well, versus last month was around 3% deflation that we'd seen coming in. So again, we are seeing a deflation. In June also, we've seen a deflation, and that is what we're seeing continuing this time.
Yes, absolutely. In contraction mode, deflation is where we are seeing the WPI data come through. Just watch out for the food inflation. So that's coming at a deflation as well as at a contraction. So that figure should come up for you. It was expected to decline by as much as 5 to 6 odd %. And I think the decline in terms of the food inflation or the deflation has been lesser than what was anticipated. But nonetheless, it's a decline of around 0.5 odd % or a deflation of around 0.5 odd % for the month of July when it comes to WPI, as compared to expectations of around 0.4 to 0.5% in terms of a deflation. So those are a couple of details which have come in. Maybe we can get our guest in.
Yep, we do have Kanika Pasricha, who's joined us. She's the Chief Economic Advisor at Union Bank of India. Kanika, CPI was much lower than what the street anticipated, much lower than the RBI's own guidance as well. And for 2 consecutive months, it's the WPI which is lower. The RBI obviously has, front-loaded a lot of the cuts and, the liquidity measures that they've announced. Do you think there's room for more here? And we also got the US jobs data that tells you that maybe the door has slightly opened up for another Fed rate cut as well. If that were to happen, do you think there could be a little more from the RBI side than what is already done and expected?
So Mangalam, first and foremost, thanks for having me on the show. The reason why CPI was tepid at just 1.55 and WPI is in deflation zone for second consecutive month. So within CPI and WPI, food has consistently been in deflation zone, and that's helping. But what's very important to understand is that, apart from the factor that subdued commodity prices, like in your show, you were talking about energy, metals lagging, that's helping WPI more than CPI. But this is where both inflation metrics bottom out in July. So at minus 0.58%, even WPI bottoms out. As the MPC is more focused on CPI, which bottomed out at 1.55, in the coming months, it is likely to trend higher. And by Jan to March next year, it's expected to move towards the 4% mark. So MPC Jan to March is at 4.4, we are at 3.8. April to June next year, they're at 4.9, we're at 4.5. So what becomes very important to watch out for is, yes, some space for rate cuts, maybe that final token 25-50 basis points rate cuts does open up is our view. But it's important to determine that the timing will be determined not by inflation trends now, but more by when growth starts to show fault lines. So yes, inflation numbers, supportive, but very important to watch out for that the space remains very muted now because front loading has already happened and the timing will be growth led. Thanks.
Okay, so you're expecting these two figures to have bottomed out when it comes to WPI as well as the CPI data. So what does that, Kanika, mean in terms of rate cuts? What are you expecting in terms of the October rate cut, October RBI meeting? Are you expecting maybe room for a 25 basis points?
So, Ekta, in our view, we don't see any change as of now. The only reason being that, the August 31st, the August 30th, the growth numbers, when they come out for April to June quarter, in our view, they're likely to track around 7%. And that's only because it's not just in India, but around the world. Because of tariff-led uncertainty, everything is front-loaded. US has averted a recession because there's so much of fiscal stimulus there. Exports are front-loaded. From the domestic perspective as well, government spending is front-loaded. The growth numbers for government spending are very high. So all this is supportive of a strong growth number in the first half and specifically in the first quarter. It's only when clear fault lines start to show, which we are hearing only in terms of anecdotes, that exporters in some sectors, specifically labor-intensive sectors, are suffering. But the data is yet to reflect that. So October, or I would say it's a September 30th policy, status quo is our view. Thanks.
Okay, status quo is your view coming in. And you're saying that now this is the lowest point that we'll be seeing the deflation, right, for WPI. And from here on, maybe we'll see that increase coming in?
Yes.
Okay,
because
and
the base effects taper out. Yes.
And what about food inflation as well, right? Because that was something that, we were expecting those prices to rise, but that's not coming even this time.
So what's happened is, if you look at some segments like veggies, we have seen an uptick on a sequential basis in food prices, specifically veggies. The only thing is it's trailing seasonal trends or the sequential uptick seen in similar periods last year or last to last year. So which is why veggies are also in deflation, pulses are in deflation on a YOY basis. These trends are supportive, but just because the base also shifts from a negative number for food WPI, even food CPI in July, we switch to a positive number next month. So a swing likely in inflation numbers. Yes.
What is your estimate then, Kanika, quickly, when it comes to growth? Because we do have this tariff uncertainty, which is going to probably play out even more. When do we probably see the impact, and what is your estimate? And what do you think the RBI could possibly do in that case?
Okay. So first and foremost, given there's so much uncertainty, we've kept our forecast unchanged. Anyways, we are below the MPC's number of 6.5. For the year, we are at 6.3. Now, just on a 25% tariff hike, the penalty impact not yet seen. We don't know whether it triggers or not. Just on 25% tariff hike, the estimate we have is 30 basis points. So the number for growth is tracking closer to 6% with a downward bias. Very important to understand, $90 billion is the annual exports to US. After excluding the exemptions, that's pharma, smartphones, etc., the number comes down to $45 billion. Only value-added impact is close to 40. That's around 1% of GDP. So at 25% or even 50% tariffs, if there's a complete stalling of exports, the impact can be significant. The channel of impact is not just exports demand getting hit. It's also the sentiment-led impact on capex, which is why, in our view, the impact is significant. But there are so many moving parts, it's difficult to ascertain an exact number. But yes, 6% with a downward bias is what growth numbers seem to be tracking as of now for FY26.
All right, Kanika, thank you so much for joining in and giving us your quick take on the WPI. 2 straight months of a negative, or rather contraction, coming in from the WPI. Kanika believes that maybe this needs to sustain on both the CPI and the WPI front for the RBI to take any action, though she believes that maybe there could be a bit of an underperformance on the CPI and WPI front on account of seasonal factors right now as well. Take a short break, come back, get you more on the markets, individual stocks. We do have the management of Supria Life Sciences joining us. Stay with us.
Welcome back. Well, for the markets, the mid-cap index is trending lower. So you can see that the mid-cap index is currently down around 0.2%, and the advanced decline ratio is in negative terrain. So that seems to be the key data point in today's trade, where we're just about consolidating, holding on to our gains for the frontline indices, but the broader section of the market is seeing much more pressure. But let's talk about one particular company which is also under pressure in terms of the stock. Supria Life Sciences is the one that we're talking about. That stock has recovered from the day's low, but nonetheless, it was a weak set of numbers this time. Saloni Wagh, the MD at the company, now joins in to discuss the quarterly performance. Saloni, hi, welcome to the show. Well, what resulted in this steep fall in terms of numbers that we've seen? A 10% decline year on year. Margins also have come in lower.
So we actually introduced one of our largest production blocks a few quarters back, which is our Module E. In terms of capacity, it's almost 350 KL. So it's a very large production block for us. And in the month of April, we had to undertake some maintenance activities because we are doing a lot of scale up of some of the new products as well as existing products in this Module E. So for the backward integration part, for the intermediate part, the older blocks have to support this particular new block. So a lot of maintenance activity we had taken up in our old Module A, B, and C. And that sort of resulted in us losing a few production days. And that's why the revenue also is slightly on the lower side this time. In terms of the margin, we have still maintained at about 36%. Of course, the lower revenue has also translated into the lower absolute EBITDA number. So that was one of the main reasons.
So what does this do to your guidance for the full year? I remember you saying you'll grow 20% or maybe on an absolute basis 900 crore by FY26. Do you think you can make up for the shortfall in the next 3 quarters and that guidance number stays? And on margins as well?
Absolutely. We are very confident that we'll be able to cover up for this. And we still maintain our guidance of 20% plus growth in revenue while maintaining that healthy EBITDA margin of 33 to 35%. A lot of it will come in H2, but from Q2 itself, you will start seeing good numbers from us.
Hi, Saloni. Afternoon. Also, what about this maintenance which happened this quarter? Is it a yearly thing? How does it work about? So we understand when can these expenses come in again, as well as performances that you've seen across your geographies, whether it's Asia, Europe. How has that done for you?
So this is not a yearly thing. This type of maintenance activity typically we do in maybe 2 to 3 years. And like I explained, this was mainly to support our Module E. Because we want to really ramp up some of our existing products as well as the new products. So you will see that this will not happen every year, maybe once every 2 or 3 years. In terms of geography, and if I were to talk about the business, I mean, business is growing. We have done very well in Europe. Europe revenue has actually gone up to 41% as against 34% same quarter last year. Even the North American revenue has gone up slightly. Asia has also done fairly well. In terms of the product basket, anesthetics have really gone up. Antihistamines have gone up. Overall, our export share has also gone up to 85%. So all the right areas for the business to grow are there. And definitely the revenue numbers also you will start seeing from Q2 itself, like I mentioned before.
Okay. Well, Saloni, I wanted an update on a couple of things. One is that you had this exclusive contract for a vitamin product, which you have for the next 10 years odd. And that was expected to provide 60 to 70 crores in FY26 itself. Has that taken off, and how much are you generating from it already? And is this guidance intact?
So the 60-70 crore revenue, what you're saying, it is supposed to give us in FY27, not 26.
Okay.
Because the full opportunity will come in by FY27. By then, we would have completed all the regulatory approvals. In this financial year and Q1, we have already started seeing some revenue come in from this opportunity. It's an exclusive tie-up for vitamin B2 with one of the largest companies globally called DSM Fairmanage. For this financial year, you can expect about 30 to 35 crores of revenue coming in from this particular CMO tie-up.
Okay, so 30 to 35 crores in FY26, and that scales up to 60 to 70 crores in FY27. How long would that continue for in terms of a contract? What's the peak sales that we can expect? And any more such contracts in the pipeline that you can apprise us of?
So you can expect at peak this contract would give us about 75 to 80 crores of revenue. And this is a fixed contract for the next 10 years. So that kind of revenue addition as well as margin addition you can expect from this contract. We already are at a very advanced stage for two such contracts. I think once the contracts are through and they are signed, we'll be making some announcements very soon. While these contracts are not as large as the DSM one, but they would definitely get us an entry into the lot of multinational companies. And then you can expect larger opportunities coming in from the multinationals. So I think very soon we'll be announcing two such contracts.
All right, we will keep an eye out on those two contracts. Supriya, thank you so much for joining in. The stock notably has recovered from the lows after opening lower on account of the clarifications that you've given. We hope to, speak to you after the second quarter as well. By then, you would have made up for some of the lost ground in the first quarter. Take a short break, come back, get you more on the stocks and markets. Stay with us.
Welcome back. Still tuned into halftime report on CNBC TV18. Well, for the markets, the Nifty is absolutely flat at this point in time, so just about higher by around 18 odd points, consolidating and waiting and watching, and a bit of caution ahead of what could take place with regards to the Trump and Putin meeting, which takes place tomorrow, and it is a long weekend. But nonetheless, in terms of specific stocks, to watch out for a couple of these IT stocks. Infosys is in focus on account of that acquisition. But separately, we have Wipro, which is up around 2% at this point in time. So do watch out for that. Financials doing well today. So HDFC Bank, ICICI Bank, both of these private banks up around 0.5% at this point. But to give us a list of all of the buzzing stocks at this point in time, let's go across to Vivek. He's standing by at the wall to tell us more.
Well, thank you so much for that. Like you mentioned, I'll take a cue from what you just said a couple of minutes ago on the back of the fact that the Nifty IT index is the one that's doing very well in the session. The entire IT pack, especially the mid-cap IT names, are seeing significant buying interest. So names like LTIM, that particular stock, significantly higher, cooled off a little bit. Wipro, Infosys, Persistent, all of these stocks doing very well in the session today. Muthoot Finance, clear standout performer both in terms of results and also the number of EPS upgrades that this particular company has seen post the Q1 results, something that's significant. Morgan Stanley also went ahead and upgraded its rating on the stock. United Spirits, very strong volume growth coming in the quarter gone by. That stock, again, has seen significant buying from the lower levels, up almost 2% today. And Aptus Value Housing, one stock from the broader end of the markets, a couple of upgrades coming in as far as rating agencies are concerned. That stock higher by over 3% today. On the other hand, Cohance Life Sciences, margin depression both on a year-on-year as well as on a sequential basis. That stock lower by over 7%. Engineers India, much lower contribution coming in from the joint ventures that the company has this time around. That stock lower by 4%. OMCs, the entire OMC pack under a bit of pressure. But HPCL was one stock, at least a couple of minutes back, was seeing significant selling pressure in trade today. And Max Healthcare, this particular stock going into Q1 was, perched at near record highs, but post results has seen significant profit booking emerge, almost 4% lower as far as Max Healthcare is concerned.
Okay, Vivek, thank you so much for that. Those were the buzzing stocks in today's trading session as of now. But what's happening in the world of F&O? What are the important cues that we should be keeping an eye out on, especially given that the market is so muted this week? We've seen those ups and downs coming in, and seems like we'll close with a gain. But will we close with the gain? Will we sustain in terms of the growth going forward as well for the market? Will we see a bit of a green coming in on the screen? Will be key to watch out for. A lot of movers that are, moving in the world of F&O as well today. So, look at the names that are coming in on the screens. Muthoot, Kalyan, all these are also moving. But for important cues, we have Mangalam joining in with us for that.
Well, a 20-point up move is what we're seeing on the Nifty. But look at some of the sectoral indices. We had the Nifty IT and the Nifty Bank, both of them underperforming in yesterday's trading session. But now they are outperforming and they are supporting the frontline index. Even as the Nifty is up just 20 points today, remember, for the last 3 trading sessions and including this session, the Nifty is up 1% this week. And if the market holds at current levels, it will break a 6-week losing streak. So that would be something that the bulls would like. It would be a significant one to watch out for. The only things that can actually, cause a bit of a dent in that sentiment is, one, the broader markets. We have more stocks declining for the number of stocks which are advancing. So those crisscross lines come up for you. The red one is fairly above the green one right now. The second one is the India VIX. Even as the market's consolidating, the India VIX has moved higher. So that's telling you we're still perhaps not out of the woods. So we'll watch out for how that pans out. Do the option writers worry? No. It is weekly options expiry today. And remember, tomorrow is a holiday, obviously, so not a lot of big moves expected in the second half of trade. A lot of straddles are written. Now, what is a straddle? A call and a put together. So those who are writing the 24,650 straddle, which is a call, has premium of almost 26 rupees. At the 24,650 put has a premium of similar amount. So it's roughly 50 rupees that you get when you sell both these options. So the option writers are expecting the Nifty weekly options expiry to be between 24,600 to 24,700. Were that range to break on either side, they've gone ahead and protected themselves by buying a 24,700 call and a 24,600 put. So you basically pocket a premium of 60 rupees and pay a premium of around 25-30 rupees to expect the market to expire in the range itself. So 24,700 call and the 24,600 put, both of them come up for you on the screen. And finally, watching out for a bunch of stocks today, we have Nuvama, which is underperforming in an otherwise wobbly market and has seen a lot of open interest build up. So that's a lot of short positions added there. A lot of long positions added on Manappuram Finance. We saw, Muthoot do extremely well in today's trading session, fairly well bid. And on the back of that, we're seeing Manappuram Finance do better as well. It's also seen a lot of long positions being added. And PNB Housing Finance. Remember, the stock has been in F&O ban for the last few trading sessions. Today, the open interest is at 81% of the market-wide position limit. If it falls below that, then maybe the stock exits F&O ban. So we'll watch out for that one too.
Okay, all right, Mangalam, thanks for that. So that's on the F&O space. We'll take a short break, but on the other side, Manisha Gupta joins in. She has with her Sashi Singh of All India Rubber Industries Association to take us through that conversation.
Welcome back. Joining us now is Sashi Singh. He's President, All India Rubber Industries Association. Mr. Singh, hi, thank you so much for joining in. As every sector is reading into the impact of those tariffs, 25% right now and 50% if the negotiations do not go through until then, how is the rubber industry, first of all, looking at an impact from this?
This is going to impact this imposition of 50% tariff by US on rubber products, 25% as a tariff and 25% as a penalty. It's going to significant, problem for the rubber industries.
As of now, when you look at the overall numbers, Mr. Singh, what is the quantum of exports to US from the sector?
Actually, we are now exporting somewhere around 7,500 crore rupees rubber product. And we are also importing from US around 2,200 crore. So trade surplus is around 5,200 crores, which is going to affect by this unprecedented tariff.
Mr. Singh, the another thing that sectors seem to be doing is approaching governments or their relevant ministries and asking for some assistance or help. What is it that the rubber industry is putting forth for the same?
We also requested government that at least start some export incentive, some extra duty drawbacks, and push on the FTA, which is like recently done in UK. This kind of help, or also government should focus on a domestic development as well on infrastructure, defense, etc. So can be that trade surplus can be get it through that industries.
Mr. Singh, that's about US, of course, which is one of the major markets for you. But when it comes to exports in sense of rubber products, what are the other markets that you are looking at focusing now?
Indian industries now should focus more on the other countries, European countries where demand is more, and also focus on domestic businesses. And we as a industries also should be, always ready for to get something better, development and upliftment in a crisis situation like this.
Mr. Singh, also when you talk about the domestic markets, what really are the numbers here in sense of demand growth?
As I told you, that number for the export is 7,500 crores.
That is the Indian exports to US. But for the domestic markets itself, do you see numbers improving here within the market, within India?
Yeah, of course, there are a number already. We are on an upper trend. All industries is doing good, as automotive is doing good, so rubber industry is directly related to automotive. And there is what I understand, our understanding is that in this tariff, automotive products like passenger car tires or trucks and buses tires are not in that penalty zone, so they are having only 5%. That also a little bit, a safer zone so far.
Well, yes, I understand the point so far there. Mr. Singh, also, when you look at the overall rubber production, since we have you with us, what is it that we are looking at in sense of deficit for the Indian markets for this year? Because we do understand that the deficit has been staying on for many years now. What is the kind of Indian rubber production, imports, and overall demand that you're anticipating?
So deficit is still there, somewhere around 5.5 lakh tons. And it is going to remain because it's basically it's a natural product and it's take its own time. Of course, northern state are doing good in this, Tripura, Meghalaya and all, but still we are in a deficit position.
What is your sense on the pricing as well? Because the rubber prices in the international markets have been slightly under pressure, given the fact that we've seen crude oil prices come off and all of these tariff concerns have been keeping rubber prices under pressure. What is your sense from here on?
It will be remain plus minus 4-5% around in a range of 200 only.
Mr. Singh, thank you so much for joining in. Well, that's the kind of information coming in from the All India Rubber Industries Association. The exports to US, of course, could see a lot of hit. And if the industry does not get help from the government in sense of incentives, in sense of otherwise they wouldn't be competitive with their peers like Vietnam and Thailand. So some bit of a concern coming in for the rubber industry as well.
Absolutely a concern coming in there. Everyone is concerned. Each sector we talk about, they are worried that what is finally going to be happening in terms of tariffs will be key to watch out for. Till then, obviously, some bit of an uncertainty is what we're watching out for. But on that note, we're going to actually slip into a very short break, and a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, a premium members only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses and curated lifestyle benefits.
Welcome back. You're watching us here on Halftime Report. The market's doing market things. So, before we go into the long weekend, there's a special segment that we do on Halftime Report. It's called Fund Race, where we speak about, the underlying trends that are playing out in the market right now. We do have with us DSG Consumers Hariharan Prem Kumar, who's obviously the MD and head of India, where they do, make investments in a lot of these D2C consumer brands as well. So, let's talk about the insurgents versus incumbents battle, which is fairly heady in the consumer space right now. And their, Insurgent's report itself suggests that over the last few years, insurgent brands, Hari, have actually grown at times 2x, 3x or 4x, and in many categories at multiple times than what the incumbents have grown at. I mean, food and beverage market grew 1.5 times, the insurgents grew 3 times. Apparel and lifestyle market grew 1.2 times, the insurgents grew 5 times. What exactly have insurgent brands done right versus traditional consumer companies, and what differentiates a successful one versus the others?
Super. First of all, thank you for having me, Mangalam. And, I think the core of it is that insurgent brands are super plugged in to evolving consumer needs and have product offerings that are best suited to modern day consumer pain points. Examples being like sulfate-free shampoos, you have zero sugar ice creams like a Go Zero taking off in a big way. So that's typically how they, survive and thrive. When it comes to the successful insurgents, there are many things that they do well. I'd recommend the viewers to look at the report. It's on our website. But I think the top 3 factors will be, it starts with the product, a clearly differentiated product that is 10x better than whatever is available out in the market. The second thing is brand. We always say this, that a business becomes a brand when it builds an emotional connect with the customer. So very brand first in everything they do. And the third, and which is also a recurring theme in our report, is capital efficiency. You know, the culture of being capital efficient, frugal growth, not raising unnecessary capital, and getting it to profitability and then scaling on the back of cash flows. So I think these three would be the big success drivers of successful insurgents.
Okay. Hari, I wanted to actually drill down on where exactly are they getting market share from, the insurgents. Is it grabbing market share from the incumbents or the existing players, or is there new demand which is being created?
It is, I think it's a mix of both. We sort of are very thematic in our thinking. There's premiumization, which is a theme that we're super bullish on. And as lifestyles improve, purchasing power increases, there are new consumption occasions that come up, in a customer's life. When we backed Epigamia, Greek yogurt was a non-existent category, right? And now it's a brand that literally owns the category. On the other hand, the other theme that's big for us is the unorganized to organized theme. Like if you take Farmly, which is a healthy snacking brand, it's largely unorganized, mainly dry fruits and nuts based products. So that's another theme, right? So I think we're still in the early stages of consumption in India. So it's more market creation, market growth game as opposed to a market share game, what you see in the West.
Hari, like you were mentioning, these are niche products which they enter into, some of them, sulfate-free shampoos. But there are so many such brands now who are coming in, small, newer brands that are coming in. How does one differentiate between each other as well in these brands as well, right? What will make them successful versus maybe someone who's launching with them right now?
No, absolutely. That's a very important question. And that's where we sort of think of it as, the positioning statement you can own in the minds of the customer, because there are so many brands screaming the same thing, as you rightly said. But you can just break it down, right? So it can, like for instance, there are many sulfate-free shampoos, but now we're seeing a wave of new insurgents, like addressing acne as a problem statement. For example, if you can own the acne positioning in the minds of a customer, in some cases you can really, I always say this to founders, if you can build a brand story around your personality, your story, then that will be unique always, right? And it's a matter of a bit of imagination, storytelling, but the possibilities are infinite.
I just want to interrupt. I think it just reminds me of the nutritional segment, which is the nutritional product segment, which is taking place. And the only thing I could think of was magnesium.
Right now it's magnesium or protein or gut health. So
or gut health.
Owning these spaces.
Creatine is
trying to just
Creatine is the big one,
space.
But I have to ask you this. You said the playbook is here. It's early days, still not, a full-fledged bloom that we're seeing in this space itself. But what we know about the incumbents is that they're quick to learn. They might be slow in execution, etc. They might be late entrants to a party, but they ensure that, when they are there, they're the ones who eventually close the house down or be the last ones to leave that party. The case in point is green tea. Lipton wasn't the first one when it joined the green tea market. They were among the last ones to enter. And many years later, Lipton's the largest one here, along with, some of the other incumbent players. So with traditional players now understanding this D2C playbook, is it going to be uphill for newer brands? I say that because you speak about the brand, you speak about the personality. A lot of the Unilevers of the world have come out with niche brands addressing specific needs or going ahead and acquiring some of these guys. So, will it be uphill? Will it be an uphill task for newer brands? That's one part of the question. And the other part is that none of these newer brands have actually gotten big scale offline. So what is the playbook for them to actually get scale offline?
Sure, taking the first question, which is around incumbents doing the playbook, I think it's just good for the entire ecosystem. Historically, in CPG, the best way incumbents have innovated is through acquisition, right? And our report has got amazing traction with the incumbents, and I know that some of them use it actively in analyzing acquisition targets. So I think it's a good thing. And the insurgent brands don't have to be worried about it, because the fundamental advantage that the insurgents have will remain, which is speed of decision making, execution speed, and the ability to thrive in niche markets. Incumbents, by definition, find these market opportunities unattractive, too small at the moment, and the execution speed is like far slower, right? So that's the, that's how I look at it. I think it's in general good for the entire ecosystem. The second question was on, sorry.
The second question was, how do these guys scale beyond the initial?
Yeah, I think, you got to be where the consumer is. We've been investing since 2012, first 9 years. D2C was not even a jargon, right? So I think the digital channels are channels where one can scale rapidly, be it Q-commerce or marketplaces. The offline world is still building the business the old-fashioned way, brick by brick, pin code by pin code, pounding the street, chasing retailers, distributors, and collecting the money. So what I always urge founders is don't copy-paste expectations of digital channels onto the offline world. It's just a game of patience. It's no longer sitting in the corporate office optimizing algorithms. That's hard work, but this is a different kind of hard work. You've got to be with the distributors, retailers, and selling your product.
Okay, all right, Harry, we've run out of time, but an extremely interesting conversation and something which we're going to probably revisit because the dynamics of the industry is going to keep changing. Thanks very much for joining in and speaking with us and taking the time out and coming to our studios. We need to take a short break, but up next, we'll get you more. But before that, remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Even as the markets are consolidating, this is our special movers and shakers segment where we track a lot of stocks that are buzzing around in today's trading session, and we tell you the reasons why in quick pace as well. So let's start with our entire team, which is standing for all the stocks which are moving and shaking around. First up is OnMobile. Vinny, what do you have?
So Q1 numbers that came in for the company. Overall, we are seeing a decent number that came in, especially in terms of revenue muted, but gaming revenue, that's a very good growth of around 31%. Mobile entertainment revenue, that is where the decline came in, 4.9% for the company. Overall gaming subscription, that's seen an improvement as well, 12.04 million subscribers this time versus just a 7.6 million subscribers last year. And obviously lower expenses and exceptional item in the previous quarter, something that supported the profitability of the company.
Good performance coming in from an operational standpoint. Ekta, Pfizer, what's next?
Well, yes, good numbers. Revenue up around 7%. The margins expanded to 34.8 versus 31.5%, and a profit which was up around 27%, better than expectations of around 170 odd crores. Separately, a couple of days ago, they did get approval for a pneumococcal vaccine for adults in the domestic market, which is basically to protect against serious infections such as meningitis, pneumonia, and sepsis. So the next trigger really would be for them to get approval for the children's or the pediatric market for this particular vaccine. So combined set of news aiding Pfizer today. But CSB Bank, that one is weak today, down around 5 to 6% post the conference call. Let's go across to Gaurav, who has more on CSB. Gaurav.
Well, yes, when we look at the bank, it actually reported very weak set of numbers. When we talk about expectation, those were actually weaker than expected. Yesterday only, during the market time, we got the numbers. Net interest income increased just by 5%, while profit that increased just by 5% again on a year-on-year basis. But what was disappointing is net interest margins. Now, they declined almost by 20%. And remember, if we look at on a year-on-year basis, it has declined almost by 80 basis point. On a con call, what management has said that this is actually the bottom of net interest margins. after this, we will see some kind of recovery, but the guidance has been revised. The lower end of the guidance has been revised down almost by 25 basis points from 3.75% in the last quarter to 3.5%. Now, this is again something which is discouraging when it comes to CSB Bank because people were not anticipating that. Remember, in Q4 also during the call, management had called out that net interest margins have bottomed out at around 3.75%, but in this quarter we have seen another fall of 20 basis points. In fact, from here on, when we look at ROAs, they have also come down to 1.03%. Management again has said that ROAs will reach around 1.5% gradually by the end of the year, but definitely on the back of weak set of net interest margins, we are seeing some kind of weakness in share price as well.
Weak names take CSB lower, but weak numbers coming in from Endurance as well. Sudarshan.
So after Minda and Bellrise Industry, another auto ancillary company that is Endurance Technologies, which has reported earnings for Q1 FY26, and those earnings have looked largely better than estimates or say steady set of numbers. All the profit, if you talk about revenue, EBITDA, all these numbers have seen a growth in the range of 10 to 20%. Even margin is hold on to steady. It's about 13%. Currently at 13.4% versus 13.2%, and the earnings continue to be led by India segment, that is the 70% of total sales. And now company said that it has outperformed the industry. If you talk about two-wheeler sales volume in Q1 FY26, volumes have declined by nearly 2%, while standalone revenue for the company has seen a growth of almost 10%. Even European segment has seen a growth of 29%. That includes Stoffel acquisition. If you remove that acquisition, the growth was just of 1%. Now going forward, what would be the tailwind? Company says that recently government has announced that mandating anti-lock braking system for two-wheelers, that will be the tailwind going forward, and it believes that growth in FY26 is going to be better than FY25.
Okay, all right. Sudarshan, Gaurav, Mangalam, Vinny, as well as myself. Thanks very much for joining
yourself?
in. Yeah.
Wonderful.
Well, and that, bringing us all of the stocks in focus on our movers and shakers segment. And on that note, it's also a wrap on Halftime Report. Business Lunch will take all of the action forward. Stay tuned.